is durable? What is it making it so durable right now?
Well, you hit the nail on the head in your opening statement, right? It's broadening out, right? We have tech, which is actually underperforming, yet we got industrials, you got SMIDs, you got transports, you got the equal weight S&P, all making new highs while technology is just digesting, right? It's not falling apart, but it's just kind of catching up with itself. And so money's looking for investors are looking for opportunities in different sectors, and you can see it happening across the board. Now, I highlighted some of those sectors, the best performing ones, and I understand we're only a week and a half into the year, but you can already see industrials, basic materials, financials, and healthcare all outperforming the rest of the market. And I think that's good, right? It suggests signs of a healthier market, not in a market where investors are running out the door because they're nervous.
Ken, do you think we're seeing lost in the sauce? And I think you touched a little bit about it in your note this morning, that we are seeing AI fatigue. We know all these stories. We know NVIDIA is going to crush it. We know Microsoft's going to report in a few weeks. Their earnings growth, double digits. They're doing great. There's no juice necessarily to squeeze out of these rocks.
Well, you know what? It's fatigue in the sense that they've had a big run. To your point, the story's not over. But look, we're in the middle of Consumer Electronics Week this whole week, and you hear it every day when you turn on the news. What's going on? You turn on the cable stations, whether it's Yahoo, whether it's Fox, whether it's CNBC. You're hearing all about what's going on out there in the Consumer Electronics Show, and it is nothing but exciting everywhere you look. So I think the AI story is just catching up with itself. I think it's going to start to once it's all settles down a little bit and it kind of digests, then we're going to start to see it take the lead again.
And as I love what Kenny's talking about broadening of the rally, and you and I were talking about that throughout December. It's good to see that moment is happening now, that people are remembering there are 493 stocks, other stocks in the S&P 500.
And you're seeing it.
And other sectors besides tech. And if you take a look at the 3 trading days of 2026, the past 3, we have seen that the sectors that you guys have been mentioning, industrials have been rallying. You've seen other sectors besides tech taking the lead. And I will point out that also when we're talking about the Dow Transports, which touched a new highs yesterday, we also have to note that we are seeing energy prices lower. You're seeing gasoline prices going into 2026. They are at their lowest level since March 2021. And President Trump, in a rally back in December, had said that his biggest priority is affordability. Of course, going into the midterms, this is something that is going to be played up more and more. These energy prices, gasoline prices, jet fuel prices lower, and this is going to be a tailwind for the economy as well.
Brooke, speaking of tailwind, right in your wheelhouse, the U.S. consumer, rates lower, potentially big tax refunds this spring. I cannot wait to hear from some of these early consumer reporters, whether it's Starbucks or restaurants in a few weeks. I think they're going to shout all these things out as potential catalysts for earnings.
And we're even hearing some positive reactions from the street right now. Oppenheimer upgrading McDonald's this morning based off exactly what you said. There's hope out there that this low-income consumer has increasingly been under pressure because of affordability. We'll have some sort of stabilization as we move into 2026. I know I mentioned it before, but instead of that K-shaped economy, analysts on the street, experts telling me that maybe we're in more of an alligator-shaped economy.
You're still in that alligator economy call out, Brooke.
I loved it, Brian. I mean, the bottom of the K maybe moving up just a little bit, that low-income consumer getting some boost from these tax returns, and that was largely what Oppenheimer said within this note. Could these further tax refunds really fuel that low-income, middle-income consumer to return to some of the spending that they haven't done in quite some time? They also cited within that note that McDonald's could also see a return because of the fact that there's this regained momentum about what they're doing about value and finding the right price point to get these consumers within the door. And that's not only the hope for McDonald's, but also fast casual players as well, like Chipotle and Cava.
Kenny, let me get back to you. I will not, if you want to comment on the alligator economy, you're more than welcome to. But like, what could go wrong this month?
I want to make one comment about what you said. Lower rates, the Fed's going to cut rates. Don't expect Bloomies and Saks and the rest of them to lower their credit card rates. They don't. So the consumer is not going to get any help.
That's just messed up, Kenny. That's messed up, man.
Tax refunds. Right? They may get help with tax refunds, but you don't think Bloomies is going to jump in and help anybody out. Now, that being said, what could go wrong? Well, there could be a lot of things go wrong, right? You could get an earnings season, which is expected to be fairly robust. That's going to start next week on Tuesday with the big banks, and the banks are supposed to be having strong earnings. That's the expectation. But if we start to see any sense of weakness or any kind of cautious guidance going forward, that could start, a little bit of a pullback, right? That could go wrong. You could get, more commentary out of the Fed. I saw Stevie Mirren on Fox yesterday telling Maria Bartiromo that we got to cut rates by another 100 basis points. I'm sitting there thinking, what is this guy looking at? The economic data does not demand that. Yet, the market, they keep talking the market into it. So if you start to get pushback that maybe they're not going to cut rates, and trust me, I don't think they're cutting in January, and I don't think they're cutting in March. And I think the market knows that. But if they start getting a hint that they're not going to cut in May, then that could also disrupt it. And the third thing is going to be the midterm elections. Look, the whole House is up for grabs, right? 435 seats is up for grabs. And so there's going to be a lot of new names on the podium there. Where do they stand? Are they left? Are they right? Are they medium? What does that mean for policy? And so that could cause some short-term chaos.
Well, Kenny, that brings me to another point. Is the market pricing in a big year for the Federal Reserve? More rate cuts, new Dove as Fed chair. We're going to cut rates. We're going to get more consumer spending. The Dow's going to go hit 60,000.
Listen, the new Fed chair for sure is going to be dovish. We already know that because they're going to be in Trump's pocket and he wants to force rates over. But there are 3 or 4, maybe 5 current voting members that are in this camp going, well, slow down a minute. We don't really think we need to cut rates. Because remember, they can cut rates. They risk igniting the fire under inflation again, which is where they do not want to go, in my opinion. So I'm in the camp that the Fed should do nothing. I think rates are good where they are, neutral based on the economic data that I'm seeing. If Stevie Mirren and the rest of them are looking at a second set of data and they're playing I Got a Secret, I can't help you. But based on what I see, I don't think they should be cutting rates at all. But I think the market is expecting 1 or 2 cuts just based on the rhetoric and the narrative that they're pushing.
And Inez, as we're watching stocks move up and to the right, Bitcoin is finally getting some love again.
Yes, Bitcoin has been seeing a bounce, and strategists are expecting that you would see a bounce this month. You had 3 straight months of losses, so that sets Bitcoin up for a nice bounce into this month. There's some divergence as to whether the rally will continue through the first half of the year, but you have strategists that are pointing to higher Bitcoin prices by the end of the year, whether it be 115,000 targets or even 150 targets. So there's divergence on those targets, but certainly you are seeing Bitcoin and some liquidity conditions that have been improving crypto in general.
Brooke, I'm still waiting. I did a check. Like I mentioned at the top of the show, lower rates theoretically should help the housing market come the spring. We're still not getting a lot of movement. I look at the home builder index XHB. That's not doing much. Home Depot Lowe's not doing much. I was a little surprised by that.
Brian, to be quite frank, I think that this catalyst that everyone's been waiting for within this home improvement retailer, home builders sector just hasn't quite hit yet. And now, as I mentioned before on the show, is that now the rhetoric is sort of changing. Instead of these consumers or Americans moving out of their homes, maybe, increasing size, now the name of the game is renovations. Could lower interest rates push consumers to take on loans to ultimately build their house into what they want it to be, instead of taking on that 6% mortgage rate after they've had 3% for a number of years. And that's what Lowe's CEO told me earlier, or rather last year. We also heard similar rhetoric from Home Depot. And I think that catalyst that everyone has been waiting for, now maybe it's a turn of the tide here. Maybe now Americans are just thinking differently about how they're going to take on this housing market. I mean, even the conversation that we had before, this is going to be a key issue heading into the midterm elections, affordability around the housing market, and what exact candidates are going to say about that. That really is going to persuade Americans and their voting power, but also how they're thinking about the state of the economy, because they frankly just don't feel confident enough to move on their homes and take on higher mortgage rates, but also perhaps the renovations that come with a new home.
Kenny, you've seen a lot of stock market records, a lot of them spent on the floor of the New York Stock Exchange. When you see a round number crossed, in this case, Dow 50,000, we're on the cusp, does that mean anything to you? Should it mean anything to investors? Do we care about this?
No, listen, it's a big round number. It's going to be very exciting. Like S&P 7,000 is going to be the same thing. The Dow 50,000 is clearly going to be kind of a bigger celebration. But in the truth is, it doesn't really matter to investors. It's great. It's going to be a reason to celebrate. Everyone's going to point to the fact that look at how strong the economy is. But in the end, it's just a number, right? Exciting, but it's just a number.
Lastly, Kenny, at this point in time, just given the momentum in so many other areas of the market, do you use the Mag 7 weakness as a source of funds and look for more opportunities on those 493 other names?
So I wouldn't use the Mag 7 weakness as a source of funds because I think the weakness is temporary, right? So I'm not selling any of my Mag 7 names at all. I'm just taking new money that I'm adding into the portfolio and using that as a source of new opportunity, right? I love the tech space. I'm not selling the tech space. There's no reason to it. It's not falling apart. This small little pullback of 1% in the Mag 7 means nothing to me in the long picture. Remember, I'm not a day trader. I'm a long-term investor. So that is not a place where I'm going to go to raise money to reallocate. I'm taking new money to reallocate.